Compound interest is the interest on investment funds determined on both the initial principal and the gathered revenue from past periods. It is believed that Italy in the 17th century was the birthplace of interest on interest, also known as the power of compound interest. It will grow a sum more quickly than simple interest, which is calculated only on the principal amount. Money grows rapidly through compounding, and the greater the number of periods of compounding, the greater the compound interest will be. Investing your money can appear extremely complicated and time-consuming. Whenever you've mastered your current financial situation, it can assist you with taking your funds to a higher level. Welcome to my channel, the Taurus Treasury. To know about the power of compound interest, watch this full video. If you like my videos, please hit the like button, subscribe, and click on the bell notification so you do not miss out on any opportunities. How compound interest works. Compound interest is calculated by multiplying the initial principal amount by 1 plus the annual interest rate raised to the number of compound periods minus 1. The resulting value is then reduced by the total initial loan amount. The power of compound interest. Compound interest grows at an ever-increasing rate because it includes interest from previous periods. Even though the loan's total interest for the 3 years is $1,576.25, it is not the same for all 3 years like it would be with simple interest in the example above. Compound interest schedules. Interest can be compounded on some random recurrence plan from day to day to every year. There are standard compounding frequency schedules that are usually applied to financial instruments. Banks typically use a daily compounding schedule for savings accounts. Common compounding frequency schedules for a certificate of deposit, CD, are daily, monthly, or semi-annual. It is frequently daily for money market accounts. The most common compounding schedule for credit card accounts, home equity loans, personal business loans, and mortgage loans is monthly. There can likewise be varieties in the time span in which the accrued interest is credited to the current balance. An account's interest can be compounded daily, but it is only credited monthly. The interest only begins to accrue additional interest in the account when it is credited or added to the existing balance. A few banks also offer something called as ceaselessly building revenue, which adds revenue to the principal at each conceivable moment. Unless you want to put money in and take it out on the same day, it doesn't do much more than daily compounding interest for practical purposes. More frequent compounding of interest is beneficial to the investor or creditor. For a borrower, the opposite is true. Compounding periods. The number of compounding periods has a significant impact on the calculation of compound interest. The essential decide is that the higher the quantity of compounding periods, the more amount of compound interest. The following table shows the distinction that the quantity of compounding periods can make for a $10,000 credit, with a yearly 10% loan cost more than a 10-year time frame. Compound interest. Start saving early. It is common for young people to forego retirement savings. When someone is in their 20s, the future seems so far away that other expenses seem more important. However, these are the years in which compound interest changes everything. Saving a small amount can pay off a lot in the long run, much more than saving a larger sum later in life. Here's one illustration of its impact. Let's say you start investing in the market in your 20s at $100 per month. Let's then assume that over the course of 40 years, you earn a positive return of 1% per month or 12% annually. Now let's say that your identical twin doesn't start investing until 30 years later. For 10 years, your tardy sibling invests $1,000 per month, achieving the same positive return on average. If you save for 40 years and your twin has saved for 10 years, it will have about $230,000 in savings, while you will have slightly more than $1.17 million when you reach that point. Despite the fact that your twin was financial planning tenfold the amount of as you, and even more close to the end, the miracle of compound interest makes your portfolio fundamentally greater, here by a variable of somewhat more than 5. A similar logic applies to opening an individual retirement account, IRA, as well as exploiting a business-supported retirement account, for example, a 400 or 403 plan. Start it in your 20s and keep making regular contributions. You'll be happy you did. Compound interest investments. A financial backer who opts for a dividend reinvestment plan, DRIP, inside a money market fund is basically involving the influence of compounding in anything they contribute. With the purchase of a zero-coupon bond, investors can also reap the benefits of compounding interest. Customary bond issues furnish financial backers with occasional premium installments in light of the first terms of the bond issue, and on the grounds that these are paid out to the financial backer as a check, the interest doesn't build. Investors do not receive interest checks from zero-coupon bonds. All things considered, this sort of bond is bought at a markdown to its unique worth and develops over the long run. Zero-coupon bond guarantors utilize the force of compounding to build the worth of the bond so it arrives at the maximum at development. When it comes to repaying your loans, compounding can also help. Making a portion of your home loan installment 2 times every month, for instance, as opposed to making the full installment 1 time each month, will wind up chopping down your amortization period and saving you a significant measure of interest. Who benefits from compound interest? Investors profit from compound interest, but the term investor can mean a lot of different things. When banks lend money and bring back the interest they receive into making additional loans, for instance, they reap the benefits of compound interest. Depositors also benefit from compound interest when they receive interest on their bank accounts, bonds, or other investments. It's important to remember that even though the word interest is included in the term compound interest, the idea still applies beyond situations for which the word is typically used, such as bank accounts and loans. Can compound interest make you rich? Yes, it's safe to say that compound interest is the most potent means of wealth creation ever devised. For literally thousands of years, merchants, lenders, and other business people have used compound interest to become wealthy. Clay tablets, for instance, were used to teach students about compound interest more than 4,000 years ago in the ancient city of Babylon. Today, Warren Buffett is one of the richest people in the world through a business strategy that involved compounding his investment returns over long periods of time with diligence and patience. It is likely that, in one form or another, people will probably use compound interest in some way to accumulate wealth. That's all for today. Hope you enjoyed the video. If you have any questions regarding this, let us know in the comments section. Like and subscribe the video, and don't forget to hit the bell button.